Welcome to FT Markets. As the US Federal Reserve prepares for this week's crucial interest rate decision, the rest of the world appears split over what might happen next, with economists expecting a rate rise, but markets expecting a rate hold. The FT's markets editor, Mackenzie, is here to discuss why that might be. Mike, the FT's just run a fascinating series on what might happen if US interest rates rise. Why is this so crucial for the rest of the world?
Well, the US economy and, in fact, US monetary policy dictates a lot of what happens around the world. In fact, we've already seen a lot of movements this year in markets, particularly in emerging market currencies, bonds and equities, off the back of a much stronger dollar, which has put increased pressure on those emerging market economies who've borrowed in dollar terms in the last few years. So when and if the Fed does decide to go, it matters greatly for markets generally.
And I think we've got our first chart that shows the movement of the US dollar already. What is this showing us? What we should be looking at here?
Well, this effectively represents the third great bull run in the dollar since the 1980s. And this is why emerging markets have felt so much pain. And indeed, commodity prices, which are priced in dollar terms, have suffered so much. You've seen a very sharp pickup in the dollar. And in the last few months, it's actually been going up and down there, consolidating. And this is one of the points of contention for the Federal Reserve, because a stronger dollar does represent a tightening of credit conditions and financial conditions for the US economy. And in fact, Goldman Sachs last week came out with a note saying that they believe the strength of the dollar has helped tighten, or effectively represents 3 separate tightenings of 25 basis points each. So in effect, the dollar has done a lot of the work for the Fed. So people say, and in fact this is what the bond market is arguing, the strength of the dollar means the Fed doesn't have to raise rates this week.
But for emerging markets, this is making them sweat, isn't it, this chart?
It is making them sweat, because the danger here is that, unlike previous periods when the Fed was raising rates, you tended to get a pickup in the dollar. What's unique about this potential rate hike cycle from the Fed is that they would effectively be the only central bank raising at a time when more than 30 other central banks this year alone have cut policy. And in fact, the big elephant in the room here is China, which has recently allowed its currency to slip or come off a peg against the US dollar. And the big fear is that rather than cutting rates, China will allow its currency to slide even more. And over the next few months, that's going to put even more pressure on emerging markets.
We're not calling this an emerging market crisis yet, are we? But some commentators are saying we could be on the cusp of something big.
Again, I mean, in the past, when we saw rate hikes and a stronger dollar from the Federal Reserve in the mid-80s and starting the mid-90s, we did have emerging market blow-ups that did occur after that. So it's something to watch for. And again, while the Fed focuses solely on the domestic side of things for the US policy, they are the central bank for the globe. And as a result, the dollar is the world's reserve currency. They have to factor in their decisions into that as well.
So we've had a really long run of extraordinarily low rates in the US, haven't we? What's happened to US markets during that period?
Well, US markets have never had it so good. I mean, you had not just low borrowing costs set by the Fed near zero. They came in and bought tremendous amounts of bonds, and they've effectively expanded their balance sheet from around 700 million to 4.5 trillion since the start of 2009. And that has pushed equity valuations through the roof in the US. It's been a great bull run for equity investors and those who came in.
We've got a chart showing just how remarkable that move has been, but it also shows that something's changed in the last few months.
Yes, and I think what you're seeing here is a very tired bull market beginning to run out of steam. In fact, we saw the first fall of more than 10% from a recent high last month in over 4 years. So we've had a correction. The question now is, do we get more? Do we actually go into what would be considered a bear market if we fall more than 20%? Now, the Fed, if it starts to raise rates, the level of interest rates does influence and help drive equity market valuations. The other key factor here, of course, are earnings, which are not looking so good in the US. Earnings are falling, and in particular, there's an absence of top-line growth or revenues. So you've had a lot of buybacks that have helped push up the equity market, but valuations still remain very high. And so there's a feeling that the US equity market is ripe for an extended period of consolidation and possibly a lot further to fall. Now, the flip side of this, of course, is that if you're an investor who's been looking at this, you say, well, where should I put my money?
Where's it going?
Well, we've already seen quite a significant amount of funds leaving the US equity market and moving into European equities. And in fact, there's an argument that with at least another year left for QE by the ECB, and the fact that European equity valuations are lower than those in the US, and that the outlook for earnings growth in Europe is much better than it is for the US, that you're looking at a European equity market that is lagging, as of still lagging today, but has room to kind of emulate what we've seen in the US thanks to QE. So that's where the money has been going, in particular ETFs, which are currency hedged. So if the euro does fall further, you're protected against the lower euro, have been very attractive for investors. And so the question is, once the Fed meeting's out of the way this week, and regardless of whether they hike or not, are we going to see an acceleration in flows out of US equities into Europe because they're banking on QE and stronger fundamentals?
Michael, thank you very much. So regardless of a Fed rate hike this week, money is already moving, with Europe a possible winner.